So the dealing range essentially gives us the equilibrium. So this shows us where we want to be buying and selling. So we took a trade from here, and we want to sell back down into the discount. So we're looking to sell high, right? There's a saying of buy low and sell high. You can avoid 90% of your losses or 90% of your psychological problems if you only focused on dealing ranges, selling in the premium and buying in the discount. Now, how do we use fair value gaps? So this is going to be the meat of the video. So notice how we have a structural high over here. We've taken out the previous day high. We're in a premium, so we're in this premium range. We're going to be understanding how to use fair value gaps. And so the beauty of this strategy, and the reason I call it a triple X model, is because it relies on three things, hence the triple. So you need to know where to trade from, what to look for, and why you're looking for it. Now, if you think about it logically, every single trader approaches the charts with some kind of a key level, right? A key level is just a generic way of saying it could be a fair value gap, an order block, a breaker block, a support, a resistance, a supply or demand, and I just call it a key level. It's somewhere on the charts where we're interested in the price action. Sometimes I call it a POI, right? A point of interest, but it's an area on the charts that we are interested in looking in. And so I'm a big believer that psychology is heavily overrated, and every single psychological problem can be fixed with a technical piece of knowledge. So if you simply waited for a break of a 15-minute fair value gap and you targeted the next fair value gap, you would be profitable, right? So if you're struggling with greed, just target the next 15-minute fair value gap, right? Cap your risk reward at 1, 2, maybe 3R max. If you're a trader who struggles with finding entries, only enter when you see a 15-minute POI. So this is what I call a 15-minute POI, and the way that I mark this out, if we kind of zoom into it, is we can see here, this is the 15-minute fair value gap just over here, and I mark out the candle before the fair value gap. So my key level is essentially this region here. If we break above, we look for a buy. If we break below, we look for a sell. So often simplification leads to more profits, easier trading, enjoyable trading, and less psychological mess. So that's kind of where we're going. So using 15-minute fair value gaps is essentially a cheat code. Now on the lower time frames, we're looking for a break and retest, and that's how you use 15-minute fair value gaps, right? Everything comes down to a simple break and retest. And now we're going to be going over the lower time frame. So a lower time frame entry model.